battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name is Nick Stenger. We are the Stenger Family Office. For the past 42 long years, it's been our mission to deliver both clarity and confidence to help secure your financial future. Well, it's episode 137. I apologize for the hiatus. We were busy finalizing some last changes in the portfolio and getting ready for the end of the year. So here we are, wrapping it up with the last episode of the Nick Stenger Show for 2023. I'm very excited because I finally get to wear the Santa suit. I bought this specifically for the show. And we're technically not quite into a Santa Claus rally yet. It actually takes it's the last 5 trading days of the prior year, so of 2023, into the first 2 trading days of 2024. So we're technically not into a Santa Claus rally, but we had such a good year in 2023. I thought I'd throw on the Santa suit anyways. Wishing you a very Merry Christmas. Been an incredible year in the stock market. I'm glad you stayed the course. I'm glad you've been coming back for the clarity and confidence each week, each episode, to get the good news on why you should stay on your plan. And I'm glad you did not panic and live to see me in the Santa suit. So here we are. This hat is very warm, by the way, so we're going to try and keep today's episode kind of compact so I don't start sweating. And anyways, but on these weekly shows, we give you the clarity, the confidence, the good news, the reasons to not be afraid. And that's so important. One of the things I like to do on the Christmas show each year is to read you the Luke version of the Christmas story, the birth of Jesus. This is Luke 2, 1 through 20. I won't read the whole thing, but in those days, Caesar Augustus issued a decree that a census should be taken of the entire Roman world. Everyone went to their own town to register. So Joseph also went up from the town of Nazareth in Galilee to Judea, to Bethlehem, the town of David, because he belonged to the house and the line of David. He went there to register with Mary, who was pledged to be married to him, and was expecting a child. While they were there, the time came for a baby to be born. She gave birth to her firstborn, a son. She wrapped him in cloth and placed him in the manger because there was no room available for them in the inn. And there were shepherds living out in the fields nearby, keeping watch over their flocks at night. And an angel of the Lord appeared to them, and the glory of the Lord shone around them, and they were terrified. But the angel said to them, "Do not be afraid. I bring you good news that will cause you great joy for all the people. Today, in the town of David, a Savior has been born to you. He is the Messiah, the Lord. This will be a sign to you. You will find a baby wrapped in cloth, lying in a manger." Suddenly, a great company of the heavenly hosts appeared with the angel, praising God, saying, "Glory to God in the highest heaven, and on earth peace to those whom his favor rests." And isn't that the Christmas story? Isn't that the heart of Christmas? Is that we know that we should not be afraid, even though we feel fear, even going way back 2,000 years ago when Jesus was born, that people felt the same fear we had today. But Jesus came to bring peace and to calm our fears. And so that's what we try to do on this show every week too, is we try to give you some clarity, some confidence, some good news. I hope you remember this message as you spend time with your family on Monday and enjoy this wonderful season. Remember that it's all about a season of not being afraid. Well, episode 137, Merry Christmas. That's the episode. That's the title. Could not be more excited. And you'll notice these episodes are a lot more fun at the end of the year when the market's up. And it's not just up a little bit. The market is up over 25%, including dividends for 2023. Last year was an abysmal year. The market was down 18%. And it's not overly surprising that we had a recovery in 2023 simply because we had such a bloodbath last year. So we shouldn't be overly surprised. All the people who got nervous and bearish last year, it could have been understood at the beginning of last year. But what I just struggle to understand is all the people who stayed bearish through the fall of last year, through the winter, even the early parts of this year, because what happened was the market started to price in the future. And again, I'm going to say it one last time here for this year on the show, but remember, if you can get this one thing right, markets are a forward-looking indicator of what's to come. They don't like to focus on what's happening right this second. By the time you read something in the Wall Street Journal, already too late to react to it. It's already priced in. The markets care about 6 months from now, 9 months from now, 12 months from now. If you're a patient long-term investor, we've always said just go in with a couple year time frame for equities. So if you got 3 years, if you got 5 years, you're definitely okay. The market statistically just does not go down more than it goes up. In fact, the market goes up statistically more than it goes down. Why? How do you know that? Because look at that long-term stock chart of the S&P 500, Dr. Jeremy Siegel, 200 years of market history. What has the market done? It's produced positive returns, not just positive, but incredibly positive, the best returns on earth, better than any other asset class. So there's only one way for that to happen, and that's simply the market goes up more than it goes down. Now, going into next year, we've got a couple of doom and gloom stories. I've pointed this out. We're going to have some downside. We're going to have a correction. You heard it here first. We're going to have a correction. Let me repeat it one last time. We are going to have a correction in 2024. Just be aware of that. Don't panic. Don't let it surprise you. And just please remember the Christmas show. I'm wearing the Santa suit, so there's no way you can forget this episode. Remember, Nick said 2023, at the end of 2023, that we will have a correction next year in 2024. Don't let it surprise you. Now, is it going to be 10%, 15%, 20%? Who knows? Who cares? If you're a patient long-term investor, you're going to use that as a buying opportunity to get more stocks on the cheap into your portfolio. We've already started positioning like this. I was working with Bond actually all of this week, all of last week. That's why we missed a couple of episodes here, working diligently just to make sure that we've got that short-term fixed income bucket for our clients right where it needs to be. So we've got enough to cover your living expenses. If you're retired, we've got enough for your RMDs for a couple of years. Even beyond that, in a lot of cases, many of you have 5 to 7 years of living expenses in short-term treasuries. We're going to be fine. Now, when that correction happens next year, we are going to be looking for an opportunity to invest some more when the market's down. That's exactly what we did in 2022. So when the market had gone down 10%, we added a little bit. When it went down 15%, we added a little bit. And then what happened in October of 2022 was the market traded off. It was down almost 25% from start to finish. We said stocks were undervalued. They were dramatically cheaper than they should have been. So we added a lot more in the fall and the rebounds of last year. Now, today stocks are about 47.50 on the S&P. I'm not telling you that stocks are radically cheap today. In fact, I don't believe they're radically cheap. I think they're fairly valued. So we're not going to see, I don't think, this massive run up in the first part of next year. We could tread water for the first couple of months. We could just get our dividends, maybe see a decline, a correction in the first quarter. Usually we get a correction in May, April, May, somewhere in there, because the market has gone up a couple percent. And some people will say, oh, it's time to take some profit. Not a bad idea. That's nothing wrong with that. But just be aware, that's probably when we see a correction. We always see one in the fall because people start taking profit. But I think the second half of next year is really going to be the game changer for the markets. And the reason why is because, remember, because the market is a forward-looking indicator, it's looking into the future. At the end of this year, right now, which is we're basically at the end of 2023 now, we're already trading the S&P on 2024 profits. Well, fast forward 12 months from now, when we're having the Christmas show in December of 24, what will we be trading the market on? will be pricing in 2025 profits. So, as your advisors, as long term investors and portfolio managers responsible for allocating your capital, we're already starting to look ahead towards those longer range profit estimates. We have a good idea of what 2024 is going to be. We have a hazier view of 2025, but right now 2025 looks very positive too. So even if we have a recession next year, which I'm not overly sold on, I don't know if we're going to exactly have a recession. We'll see. I did that episode one episode ago, Recession or No Recession. Go back and watch it. I talk about the whole recession predictions, but even with a tiny recession next year, then that would mean 2025 is this big rebound year. So that's where I say just stay on your plan, look forward to the future, because nobody should be buying stocks unless they have a 3 or 5 year time horizon anyways. So knowing that you have a 3 year or a 5 year time horizon, stay invested, get your cash to work, get a little bit more to work when markets get lower, and dollar cost average maybe when markets are a little bit frothier like they are today, and you will be just fine. You'll make it through this. You're going to fast forward to the end of 24. I think you're going to be up from where you are today. I think at the end of 2025, you're going to be up from where you are today. So who cares what price you buy the S&P at? If you buy it at 4,500, 4,600, 4,700, who cares? Stay invested, because over the long run, stocks will go higher. Okay. Let's recap the past couple years. I think this is really important. I did this at Investor Day in my presentation. You can go back and watch that too. I think it's coming soon. But let's just recap the past couple years under COVID. 2019, booming record, all-time high, melt your face off year. I remember Jamie and I were sitting on the beach in Florida watching the fireworks, New Year's Eve. That was, New Year's Eve of 2019 going into 2020, right before the lockdowns happened. Nobody knew what COVID was at the time. And we were sitting at this fire pit, and some people had sat down, left a $200 bottle of champagne, basically completely open, didn't drink it, left it there, said, you can have it. We sat there, looked at each other and said, wow, this is truly excessive. We are in the peak. I'll never forget, Jamie and I looked at each other. We said, things must be maybe approaching a little bit of a peak here, knowing that people are just leaving Champagne. They're going on crazy trips. They're spending money like never before. Sure enough, 2020 hits. Now, nobody could have predicted COVID exactly. COVID hits. March of 2020, basically everything's locked down. Market plummets 35% in the spring of 2020. But by the summer, the market had already started making its recovery. Remember, it's a forward-looking indicator. So rightfully so, the narrative was we're never going to get back to normal. I mean, we had such uncertainty in 2020. Nobody knew if we were ever going to go back on a cruise. Nobody ever knew if we'd go back on an airplane. We thought we'd be locked down forever. They started calling it the new normal. Now, we didn't. Our group didn't. We said, we're going to go back to the old normal. Just wait. It's coming. It's going to take some time, but we're going to reopen. We're going to go back to usual life. Sure enough, 3-4 years later now, we've been vindicated. That's correct. But at the time, the narrative was that we're never going to go back to normal. Well, remember, the market is usually right. The market is the weighing mechanism that will tell you, that will really expose the narrative and tell you if you got your prediction right. Well, by the summer of 2020, we had started making a recovery. What was the market telling you? We were going to reopen. We were going to go back to normal. Some of the excesses, though, that started in 2020, and I'm talking about the idea that we were going to sell 3 Pelotons per family. We're going to have a Traeger in every home. Everybody was going to be shopping for a car on Carvana. All these different ideas that we would never go back to normal created some excesses with big tech. And so what happened, and I'm sorry, not big tech, high octane tech. And so what happened was a lot of people bought into this narrative that we should trade risky tech stocks for 10 times sales, 12 times sales, 15 times sales. That's where you saw some of these companies just trade for ridiculous prices, quite frankly. A company called DocuSign, now they're exploring a strategic sale. It's not a bad company, but it just got excessive. It got to the point where people were trading DocuSign for like 15 times earnings or something, or 15 times sales, which is crazy. So anyways, you get through 2020, you end 2020 positive, which is wild. Think about it. We locked down the economy. We turned it back on. We weren't even really fully back open until 2021. We pumped a bunch of money into the economy and stimulus, and we ended 2020 positive 20%. Hard to believe. Now, 2021, positive year, because remember, people were starting to get back to normal. It was the great reopening. At the end of 2021, we traded the S&P at basically all-time highs, pretty much where we're at today, about 4750. Not a whole lot of difference. So if you look at December of 2021, if you put money in then and you held on till today, you're finally just back above your break even. And with dividends, if you stayed invested, got invested at the peak of 2021, stayed invested till today, December of 2023, you're now approaching a 3% total return because of the dividends through that time frame. Yes, it's true. Cash has actually outperformed the S&P over the past 2 years. That's just the reality of printing money. But I want to point out why that's important. The fact of the matter is that everybody right now is saying, oh, the market's not clearly correctly pricing in all the craziness with the Fed. There's not been a true pricing of the downside. Therefore, we're going to have a ton of downside in 2024 because people are exuberant. They're overly excited now. That's just not true. If you actually peel back the different sectors, if you look at what's worked the past 2 years and what hasn't worked, growth has actually gotten hammered the past 2 years. All those risky tech stocks, all the high octane growth, all the stocks that didn't make a whole lot of sense, 15 times sales in 2021, are nowhere close to their all-time highs. And so I would argue that the Fed actually crushed the growth story just like they intended. The value story, the dividend story, like we've been arguing for, not just high dividend, but dividend growth and big tech paired together, has done fine, just like it should. The market has actually acted rationally through this 2-3 year walk through the wilderness. And that's what I've been calling it. 2022, the reason stocks were down is because we had a mini recession in the summer of 2022. Call it political reasons, call it whatever you want. I'm not going to make a comment on that exactly, but what I will comment on is the fact that nobody said we had a recession in 2022. If you look at the way energy stocks or energy prices spiked in 2022, if you look at how we had declining real GDP 2 consecutive quarters in a row decline, you would have said that was a recession. I believe we had a recession next year. Who knows if they ever go back and call it? That's the National Bureau of Economic Research, NBER is what it's called. Who knows if they ever go backwards and say, okay, we actually did have a recession in 2022, but the media certainly didn't cover it. Because of that, I believe in this year, 2023, and at the end of last year, a lot of people were looking for doom and gloom that just wasn't going to happen. Why? It already happened 6 months ago. It already happened a year ago. And now, today, the recession happened 18 months ago. By the way, we don't get a recession usually every 3 years. It just doesn't happen. They're usually 8 or 10-year cycles. So my point with all of this, with all this analysis, is just to say we may not have a recession, a true hurt, just a terrible, think 08, 09 style recession for maybe another 5, 6, 7 years. It's just not likely that we have those big declines each and every year. Could we see a pullback next year? Absolutely. But I believe that a lot of the doom, a lot of the gloom is behind us. Stay on your plan. Do not be nervous for 2024. And if you watched my Outlook webinar that I did a couple weeks ago now, what I said was that profits were going to be higher in 2024 than they are today, that the Fed is likely going to cut. Now, I don't think they're going to cut as much as people think, but I do think they're going to cut a little bit. And for those reasons, we could see the S&P hit 5,200 points by the end of next year. That's about an 8-9% increase on where we're at today. I am bullish for 2024. I am positive. I'm buying stocks in my portfolio. We're buying stocks for clients. Stay on your plan. Do not panic. I told you to buy at 4,200. I told you to buy at 4,300. I told you to buy at 4,400. A lot of you listened to us. Thankfully, you bought. You kept dollar cost averaging in. You bought some at 42. You bought some at 44. We bought a little bit more at 4,500 in some cases. Well, now the market's 4,700. And so a lot of doom and gloomers, a lot of the people who have been sitting on the sidelines for way too long now are saying, Nick, I'm just going to wait till there's a correction to get invested. Well, guess what? We could be waiting a long time, and you could continue to have to buy at higher prices than we are at today. So what I have said is buy when you have the cash, get invested when you have the money, stay on a 3 or 5 year time track. If it's money for a car next year, okay, put it in cash, right? Put it in money market. If it's money for your 3 to 5 years of living expenses because you're retired or approaching retirement, keep it safe. I'm not saying to risk that safe money, but what I am saying is for the equity side of the portfolio, don't get bearish. You are going to pay the price in the end and regret it. So let's talk 5 reasons to be bullish. We'll wrap up on this for this week's episode and this year. 5 reasons to be bullish for 2024. Number 1, business has been doomsday prepping. We all have friends and neighbors who doomsday prep. They do the canned food, the bunkers, all the different gold, whatever, silver coins. We get it. We sympathize with these people. We understand it. We're right there with them. However, businesses have been doing this way too much. They've been doomsday preparing for a category 10 hurricane. And even if we have a hurricane next year, I'm talking an economic hurricane, it might only be a category 2. So they've gone too aggressive. They've evacuated all the people. They've gotten everybody into bunkers. They've gotten all the canned food ready to go. And I just don't think they're going to have to tap into it. I think they've gone too bearish, and they're going to have to pivot. Business will have to return to growth mode next year because otherwise their stock will get hurt. Remember, the stock market loves one thing. That's profit growth. It doesn't matter if you have great current cash flows. That's fine. Okay. You should pay that out in dividends. You should do buybacks. What the market really wants to see is future growth. That's why all of the market is valued on growth rates, 10%, 12%, 20%, like big tech gets. That's why big tech is doing so well, because they get better growth rates than some of these legacy zombie S&P 500 companies. And so the fact of the matter here is that business will have to return to growth mode in 2024. Now, small business and mid-cap business, I am more concerned about. I don't think they've doomsday prepped enough. I think they've gone too, I think they went too aggressive in 2021 and 2022. And now I think they're going to pay the price. I do think there will be bankruptcies. There's already been tons of layoffs. That's not a surprise. I wrote an article in April of this year saying layoffs are coming. No surprise. If you've been following the show, you are not shocked that layoffs are here. Nike just did layoffs. A lot of strong companies are laying off workers because the demand has gone down for their product, or they realize we have too much headcount. But for the best run S&P 500 companies that didn't overdo it during COVID, what are they doing? Well, they're sitting on a mountain of cash. They don't know what to do. That cash is actually a drag on their return. It's a drag on growth. And so they're going to be forced next year, in my opinion, to get that cash to work. They're going to have to do M&A. They're going to have to buy companies. They're going to have to do dividend. They're going to have to do buyback. And because of this, I believe that upper echelon, the top 50 of the S&P 500, which has been our strategy now for the past 5, 6, 7 years, especially, has been to say, hey, the top companies next year could outperform again because they've got all this cash. They don't know what to do with it. They're in a very good position. It's not a bad thing that their CEOs have been preparing for doom and gloom. It's not a bad thing that they've been doomsday prepping, but they're going to have to pivot, whether it's the first quarter of next year. I'm not convinced. Probably the second half of next year, as they look forward to 2025, they're going to say, hey, we better start growing again, or else the market's going to punish our stock. That's why I think the second half of next year is going to be good. So that's reason number 1. Businesses and large companies are in a good spot because they've prepared for a rainy day. Number 2, the consumer's still strong. Consumers have not been this doom and gloom bloodbath that people have been calling for. I see it all the time. You see it. You go out to downtown Naperville. You go out in Houston to the suburbs of Houston. You go to downtown Chicago. You go anywhere you go, it's packed. You can't get in. You got to get a reservation. There's no parking. There's no restaurant reservations. The travel's busy. The airports are busy. Everything's packed. Consumers have money. Why? Because they all fixed their mortgages in 2020 and 2021 at 2.5%, 2.75%, 3%, 3.5% mortgages. So they're good. They're paying less money today as a portion of their income to debt service than ever before. And because of that, they have excess money to spend. Also, gas prices are coming down. Remember, we spiked on gas prices last year. All of that's down. That's a benefit for consumers, especially lower end consumers. So people still have cash. It's not the COVID cash, it's not the stimulus, but it's still cash nonetheless. By the way, the 10-year Treasury is now trading at 3.83%. Let's round it out, 3.8%. Mortgage spreads are typically about 1.5% on top of the 10-year. So if you take average mortgage spreads, it's projected that by summer of next year, a 30-year mortgage is going to be back down to 5.2, 5.3, maybe 5.5% at the upper levels. That's a positive for consumers. Now, could we see a reemergence of inflation because of that? Yes. And that is one negative. I'm not always completely bullish. There's always, we're trying to call balls and strikes. We're trying to tell you what we really see. One thing I am concerned about is if the Fed does pivot next year, which it looks like they're going to, we could see that Arthur Burns resurgence of inflation. That's a 3-4 year down the road problem, maybe 2 year down the road problem. It's not a problem right now. As we see a reemergence, which I think we will, of inflation, remember housing inflation is big, all the rest of it, likely the Fed is going to have to stay more restrictive with interest rates. I'm not talking that they're going to be at 5% forever or go to 6 or 7%, but they could keep rates around 4.5. That's not the end of the world. It's not the end of the world for large cap companies that have cash. It's not the end of the world for strong balance sheet individuals like you and I. It could be a problem, though, for, again, the smaller end of the spectrum, the smaller caps, the mid caps, the lower income families. That's who I'm concerned about. With interest rates staying higher than we expect for longer. That's what's going to cause the correction or the recession down the road in the future. It's just not a problem right now. You got to stay invested because I think we're going to see positive returns 2024, 2025. Maybe we have an issue 2026. Maybe we have an issue 2027. But nobody's got a crystal ball. So you can't invest based on something that might happen 3-4 years down the road. Consumers still strong. Let's talk number 3 reason to be bullish here. Interest rates are likely to come down, but I'm going to just put a caveat on this and say, if interest rates don't come down as much as investors think, we're pricing in a lot of rate cuts next year. If we don't get as many rate cuts next year as the market thinks today, again, we're going to see a correction. But long run, that's not a reason to panic. I think you buy more and the Fed will eventually pivot, whether it's next year or 2025, stocks will be higher because rates will come down. All right. Next reason to be bullish here. We are entering the 4th year of the presidential election cycle. The first year of the cycle is usually positive because we just came out of uncertainty. We weren't sure exactly what we got. Now we know what we're going to get for the next year or the next 4 years even. The market loves certainty, whether it's Republican or Democrats, whether it's a radical policy on either side of the aisle. The market just wants certainty. So the first year of that presidential election cycle is usually pretty positive. That's what we had in 2019. So, 2020. 2021, we had another good year. That year 2 of the cycle is usually pretty good too. It's not as good, and sometimes it can even be negative like we had in 2022, but it's not the end of the world. Sometimes you go down 3%, sometimes you go down 10%. Last year, we happened to go down almost 20%. But year 2 is still sometimes an okay year, but usually more negative than it is positive. That was 2022. Now, 2023 is the 3rd year. That's the 3rd year this year of the cycle. That can be one of the best years. Why? Because you just had the midterms, because there's, again, more certainty built in. Year 3 of the cycle is usually pretty good. What you're going to be surprised to know, year 4 of the cycle, next year, 2024, where we had the election, is usually a positive year. It's not as positive on average as 2023 will be, the 3rd year, and it's definitely not as positive as the first year, but it's not nearly as bad as the second year. if you go back now through all the presidential election cycles, stock market's been up high single digits in that fourth year to the tune of about 8%. So this is where I say 2024, you follow those cycles, we could actually have a really good year just looking at that presidential election cycle. All right, last reason, fifth reason to be bullish for next year. There is so much stinking cash on the sidelines. There has never been more dry powder than there is right now. And there is literally trillions of dollars trapped in money market funds that is eventually going to come out. It's already started coming out. A lot of these portfolio managers, a lot of mutual fund managers that were overly bearish for 2023 have started doing this thing, window dressing, like they do at the end of every year, buying the stocks that went up. I just saw a bunch of portfolio managers added Nvidia. They're like, hey, we had Nvidia in the portfolio. Yeah, you had it for the last 3 weeks of the year, but you missed the rally for the first 11 months. Now, I won't give them too much of a hard time on that because we didn't have it either. But I do think that other buying that's going to come in, all this cash that's sitting on the sidelines, whether it's private equity, whether it's hedge funds, whether it's other portfolio managers, is going to put upward price pressure on the market. That's a positive for markets. They're going to realize, hey, if we don't get in now, the next time that we're going to buy, it's going to be over 5,000 points. So they have to do something to dress the windows, window dressing. So there's a lot of cash on the sidelines. I think interest rates are going to come down, whether it's 24 or 25. Don't let it stress you out. Interest rates will come down at some point. Consumers still strong, and business has been doom and gloom prepping and doomsday prepping. They're going to have to pivot next year. Ed Yardeni says that earnings are going to be $280. He's kind of the earnings guru. He's a perma bull, I guess you could call him, although we try not to call people names. Ed Yardeni has been very bullish, and that's been the right move. He's been bullish, and he's been right, so we like him. And for 2025 now, he says S&P earnings are going to be about $280. At a 20 price to earnings multiple, the S&P would be worth 5,600 points. The big question is when, which I would call that the promised land. Remember, we've been kind of walking through the wilderness here, moving our way back to the promised land. It's been not 40 years, thankfully, like the Israelites, but it's been about 4 that we've been kind of wandering through the wilderness. 5,600 points would be really the promised land. The question is, when do you get there? Do you get there in 2024? I really doubt it. I would welcome it. I'd be okay with 5,600. That's a nice little increase from where we're at today, but I doubt it. I think we're probably going to get there in 2025. Maybe it takes us till 2026. Who cares? If you take that 19% price return, you add in the dividends, which are about 1.5% to 2% on top of that, you're looking at long run average equity returns of 8 to 9%. Who cares? That's what they've been for their entire 200-year history. So my point is that over the long run, markets usually get it right. It might take us a little bit in the short term to figure it out and work through the data and work through the panic. But over time, markets will get it right. Stocks will keep compounding at that 8 to 10% level. Bonds will go back to their lower levels of 3 to 4%. And inflation should be about 2 to 3%. So after inflation, equities will continue to help you keep up with the rising costs in goods and services. We're going to have downside. We're going to have corrections. We're going to have doom and gloom news. But remember, all the doom and gloom reasons that you were worried about this year, I bet you can't even remember 1 or even 2 of them for right now. Same thing's going to happen in 2024. This guy, Harry Dent, is out there saying markets are going to go down, 84% next year. Please ignore that nonsense. Please ignore that garbage. This guy is quite frankly, a kook. Please don't listen to these crazy people who are trying to sell you a book or get you to click on their link on their website and buy a subscription. Please don't listen to these people. They have been wrong year in and year out. They're right once every 10 years. And the media, basically parades them around and says, look how great they are. They called it, but they're usually wrong. Turn that nonsense off. Turn off the fear. And please watch the data. Don't listen to the narrative. Watch the good news of what's going on behind the scenes. Get out in the economy. Go see it for yourself. And I think what you're going to see is that things aren't nearly as bad as you might think. Thank you for being with us, episode 137. I just want to thank you to all of our clients who made the transition over with us to our firm, Stenger Family Office, and are with us over here. I want to thank everybody who is a client who has navigated these past choppy years and trusted us with your hard-earned money, and we take it very seriously. Thank you for the responsibility that you've given us, and we just so appreciate the partnership over the years. Thank you for another wonderful year in 2023, and I think next year, 2024, is just going to be another phenomenal year when it's all said and done. Thank you for being here. Merry Christmas. Hope you have a happy New Year. We'll see you in the new year.